Welcome everyone to Realty Plus Masterclass webinar. I'm Sapna Srivastava, editor for Realty Plus magazine, and this webinar is being hosted in association with Nisus Finance Investment Managers and See and Recruit. Our technology partners for this webinar is Intersnet Tech Show. And as we all know, the topic for today's webinar is investment and fund strategies post-pandemic. I'm sure everyone has a lot of questions on this subject. You know, what is the scope of investment going forward in real estate? The lockdown has been extended. What are the cash flow and liquidity status of developers to complete projects, and many more. So we have a very eminent set of speakers today who would be answering all these questions and would be presenting their own expert views on this very topic. But before we go on to the discussion and I introduce the speakers, a small brief about Realty Plus. Realty Plus is part of Exchange for Media and Business World Group. Our monthly publication, Realty Plus magazine, has been part of real estate industry for more than 16 years now, and it's available both in print and digital edition. Realty Plus coffee table books are collector's edition, and they are, every year they come out on a specific topic with exclusive information on that. Our soon to be launched coffee table book is on Super CXOs, the top 100 realty influencers. So watch out, coffee table book from Realty Plus. Apart from publications, we also do physical events across 7 cities of the country. This is the Realty Plus Conclave and Excellence Awards, where we not only have knowledge seminars, but also felicitation for individuals and companies for the good work in that particular region. Now, we are also doing e-events, such as the Masterclass webinar that we have today. We also have Realty Plus Real Talk series, where we talk to industry experts for their honest views and opinions on varied segments of the real estate. We also have a Realty Plus initiative called Digital Connect, where we connect to all our readers and partners and promote our products through social media. We also have an e-newsletter, which goes to the entire database in the morning with the latest news and stories. So this was a small snapshot of what the products from Realty Plus are. If you want to connect with us, you can get in touch with our publisher and business head, Ms. Tripti Kedia. The details are right there on the screen. You can write to her at tripti@exchangeformedia.com. Coming back to our discussion for today, as I said, we have a great lineup of speakers today. And also to inform you, we will have a live poll going on during the discussion for all the viewers to participate in. And at the end of the discussion, we will take the audience questions for our speakers to answer. I now introduce the moderator of this discussion today, an expert in finance and also our strategic partner for this webinar, Mr. Amit Goenka. He's the MD and CEO of Nisus Finance and Investment Managers and Nisus Fincorp. Welcome, Mr. Goenka, to the show. Our speakers in the alphabetical order, I introduce Mr. Boman Irani. He's the Chairman and Managing Director, Rustomjee Group, and he's also the Vice President for CREDAI National. In fact, under his able leadership, CREDAI is doing a lot of good work as representative of real estate industry. Welcome, Mr. Irani. It's a pleasure to have you here with us today.
Thank you.
Our next speaker is again an expert in the field of finance, Mr. Karan Bhagat. He's the founder and managing director and CEO of IIFL Wealth. Welcome, Mr. Bhagat. It's great to have you here today with us. Our next speaker I introduce is the young and dynamic managing director and CEO of Godrej Properties, Mohit Malhotra. Welcome, Mohit, to the show. Next speaker I introduce is authority on finance and a very knowledgeable Mr. Sunil Rohokale. He's the managing director and CEO of ASK Group. Welcome, Sunil, to the show. Next panel member that I introduce is the veteran of the industry, and he has many years of experience in real estate, Mr. Venkatesh Gopalkrishnan. He is the CEO for Shapoorji Pallonji Real Estate. Welcome, Mr. Gopalkrishnan, to the show. And now, lastly, we have again a very seasoned professional in real estate and finance, Mr. Vinod Rohira, who is the MD and CEO for commercial real estate and REIT at Raheja Corp. Thank you everyone for joining in today. And as I said, it's a high voltage panel, and we are looking forward to a very informative and interesting discussion. So I hand it over to Mr. Goenka to please take forward the conversation.
Thank you very much, Sapna, for the wonderful introduction. It is an absolute delight and pleasure and a huge privilege for me to be able to moderate such an august panel. It's very, very rare to get each of these people, despite being dear friends, to take out time for an hour plus on a Saturday morning and be present with us to share what they have done to transform their organizations into pretty much pole positions within less than a decade. It's extraordinary journeys that they've charted. And I think hence I believe that they're truly capable of leading the industry, the financial services and the investment and asset management spaces into the new dawn, into the new light, see them through the next side. And this is really the endeavor at this event and at this webinar, is to hear from each one of them the strategic direction that they envisage to take, the key ingredients that have helped them transform the organizations into pole position, which will continue to hold them in good stead and also consolidate and lead the industry to the other side. Some of the things that they're seeing, which will act as key enablers and will really tip the scales in each of their favors to create a more visible, a more vibrant, a more dynamic, a well-governed and investable industry for the global and local investors. I am told that we have amongst us in the audience a very, very huge group of peers. Unfortunately, all of them could not be on the screen, but it's very, very clear that we are espousing to hear from each one of you today to understand the endeavors that you've taken in the last 4 to 6 weeks, more specifically, and how do you see yourselves more, going out in 2021, not necessarily the next 1 or 2 quarters. I'll start by inviting Sunil to share his few minutes on on the organizational and the economic direction that he sees from his point of view. Thank you, Sunil, and welcome.
Good morning, everyone, and good morning, all dear panelists. I think it's a great time, and I think we should reflect on the current situation vis-a-vis one of the very important sector of the economy, which is real estate, which contributes substantially in terms of job creation, in terms of contribution to the economy, which is 8 to 10%. And hence it is important for all of us to really look into the introspection kind of a mode, that what has changed and what is going to be the new normal or the new way of functioning. So to be honest, the real estate as an industry, residential in specific, for last 5 years have really seen a difficult times. And we all were struggling with the fact that there was a falling demand. There in some sectors, some specific micro market, there were rising prices. We also have seen the developer balance sheets were highly leveraged. The debt was at a higher level. The cost of the debt has increased. Equity was much lower in quantity. The cost of equity also has increased. And I think in all these have actually resulted into, and even some of the government related challenges regarding delays and master plans, and the cost of government charges also has increased. Net supported by the NBFC crisis, then we have HFC crisis. So we all have only heard negative about it. So pre-corona, we as an industry were in trouble. Now, what comes to my mind is that the name corona suggests that we are all scared, we are worried, we are having tougher times in managing cash flows, expectations of the stakeholders. But I still feel one Hindi line, corona ko kyun rona? Ye rone ka time nahi hai. So I feel personally that post-corona, the life is going to be a new way, as if everybody has got renewed, as if everybody is now fresh and the past is behind. So one has to think with a new normal, new way of functioning, So if you ask me honestly, what is going to be the way forward in the new dimension of Corona is that heightened governance, heightened disclosures, good quality products, understanding your customers, correct, are going to be very, very important. I think there is also going to be a new way of evaluating a risk in real estate. And new way of evaluating an opportunity in real estate is also going to be completely different than what traditionally we were thinking of. Traditionally, if you have a land, you have a FSI, you are in city center, you are in a suburban part, and you had a brand, commonsensically, a lot of sales was happening at early stage. I think all those assumptions need to be revisited. And I think that is only fair from all stakeholders' point of view to arrive at a win-win transaction and a deal structures. I think going forward, developer size is going to be very critical. Developers' ability to attract capital, debt or equity is going to be very critical. And I think it is also going to be in an era with a lot of predictability, control, risk management would be expected by every stakeholder when they would like to either buy a house or they wanted to invest into a project or they would like to go forward. So net, I think, obviously we are going to discuss much more in detail, but to set the agenda right, that I feel everything is not lost. There is a lot of opportunity the real estate is going to bring to a table, but the way we are going to look, the way we are going to see, so we will be reviewing, we will be relooking, and we are reallocating the capital, which is true for the private equity funds, the lenders, the mutual funds, or to that matter, even end home customer is also going to be different. There will be impact on commercial asset, which is quite well in 5 years. But let's see. I personally feel we need to critically, we don't have to criticize the situation, but we have to critically evaluate the risk and opportunity and find a golden mean that this industry is probably the next driving force the economy to go back to the 7% plus rate. So that's I feel that is the current situation, Amit.
Thank you very much, Sunil. This is an excellent opening remark, and you've rightly set the tone for the expectations as well as the psychological expectations to be had out of this, which is fantastic. Mohit, if I can bring you in, you obviously also trailblazed the residential market space in India over the last several years. How do you see transformational and leadership roles taking this new opportunity or this new threat forward? What are your strategic views and directions?
Hi, good morning, everyone. It's such a pleasure to be part of this group. I completely agree with Sunil on his opening remarks. I think as an industry, we have been going through one crisis after another. We started with demonetization, RERA, then NBFC crisis. So, it's been almost 8 years of now downward cycle for the residential real estate. Of course, Corona came in a time when most people were expecting the cycle to turn around. So it is another crisis which has come in. But overall, if you ask me, I remain very, very optimistic between medium to long term. Of course, there will be a short-term disruption. For 6 months to 9 months, depending on how long the lockdown continues and the economic impact of it. But, ultimately, I feel, Indian economy is going to bounce back strongly. And residential sector, which has been going through a cyclical downturn for almost 8 years now, the affordability is at one of the best levels. So once people's confidence comes back, we will see a very large surge in the demand. However, while the demand might come back in a year or two, what trend which was started since 2017 is going to continue to accelerate, which is a trend on consolidation. So, some of the large players, the top 10 players in Indian real estate market, I feel will disproportionately share, gain market share in the current environment. And I think that is something which, again, as a we feel very bullish as a company. We feel this will also be a time where people will focus on their core strengths. So some of the people who specialize in land or approval related expertise might probably just go back and do that. and some of us who specialize on development business will do that. So I see an era of partnerships between multiple developers, large developers like us, and of course the financing partners like Sunil or Karan or many others. So I think it's a very, very interesting time. It will create a lot of opportunities for people with good brands and balance sheet. And I'm actually quite optimistic. Just waiting for this, to end and for the life to get back to normal.
You shared a few anecdotes, Mohit, on how things have looked very optimistic even in the last 4-5 weeks. Would you like to share that?
Yeah, I think, when the lockdown happened, we officially took a lockdown before the national lockdown, somewhere around 18th of March. And, all our teams were asked to work from home. And, obviously you would expect it to be a complete, halt in terms of all activity, especially sales. I was actually quite pleased and actually quite surprised that in the last 15 days of March, we did close to 800 crores of fresh sales, of which actually 500 crores was actually fresh sourced and closed within that period. So people, our teams very quickly adapted to digital platform. All of us for the first time in our life started using Zoom and Microsoft Teams, which were available for a long time. And very quickly we could see that customers were also willing to buy. And actually, I mean, we are a listed company, so I can't comment about what's happening right now.
Of course.
But I remain bullish, and I'm. It's not that it's completely standstill. Unlike the auto sales which were reported just a couple of days back, where auto sector has reported almost zero sales.
That's
I
right.
think for us as an industry, we will be still reporting maybe not a record sale, but definitely some kind of a decent numbers. So I think remaining optimistic. I think one other thing, Amit, which probably you had also mentioned in your opening address, I think there will be a time now where some of the people, especially people with a longer term horizon and, investors, especially long-term investors, I personally feel might start coming back into real estate because, clearly things cannot go worse from here. So we are at the bottom of cycle and people do understand then there are great opportunities because see, from a pricing perspective, the prices have come down quite dramatically. If you adjust for inflation adjusted prices, it's really come down very significantly. Interest rates have come down. So I think it's all the macro factors are in place. Now it's anyone's guess whether it is a 12 months recovery or 18 months recovery, but people who have a 3-4 year, 5-year horizon, I think it might be an interesting time to start investing in real estate as an investment asset class. So I wouldn't be surprised, if people start thinking about it. So I think, after once this thing stabilize and the jobs stabilize, the economy stabilizes, we could see a surge.
Absolutely, that's wonderful, Mohit, and that brings me right on to Karan. You talked about long-term capital, new investment strategies. Karan, you lead one of the largest AMCs, private AMCs in the country. We'd like to bring you in terms of your views, in terms of new capital formation and expectations that investors have had. You've talked about some of the things that need to be also done and how you're leading the change on that.
Thank you, Amit. Good morning, everybody. It's a delight to be here. I think I don't want to focus too much on the negatives. I think we've heard enough of it. I think it's well known. But I think these are challenging times. And I think as we look forward to the next 3 to 5 years, we look forward to a lot of positives. But we need to also have a cautious approach. What is for certain is demand eventually will come back. Things will look better. But what we need to ensure is all excesses will really hurt all of us. And it really doesn't matter which industry you are in. You could be in real estate, you could be an NBFC, you could be a capital market player. Any excess will have to be reduced either forcefully or otherwise. In some businesses, the excess could be debt. In other businesses, it could be just the entire operating leverage in the business. In some business, it could be the operating expenses. In some other businesses, it could be cost of capital. But excesses will have to get reduced. And unfortunately, this will lead to something which Mohit pointed out to. It will lead to a lot of consolidation across industries. And I think that may become one of the most predominant themes in the recovery over the next 12 to 24 months. You will see a lot of industries consolidate, shrink, and potentially the top 10, 15 players will end up having a larger market share. The second thing I think which will happen is innovation in business models and right partnerships will become extremely critical. Both will provide a lot of stability because the ability to get long-term capital, while we talk about it, more often than not, is not only financial in nature. It needs to be strategic in nature. And as we look at a lot of sovereign funds, pension funds across the globe, the right kind of capital, which is longer term sustainable, often ends up having a certain element of strategicness in it. It's not always financial. So I think right partnerships for every industry as we develop over the next 3 to 5 years is going to be critical. As entrepreneurs, we need to be open to be able to dilute some equity and share part of our gains and profits to get the right partners in and get the right capital in. It's not always going to be possible for us to raise either fixed income debt or equity at our terms. We'll have to build long-term strategic partners, even if it comes at a little bit higher cost than we would ideally like. But it has to be capital which will stay with us through thick and thin. Innovation is going to be a key. Okay, in our business, in every business, everything's changing very, very dynamically. Today, you know, a single video post pretty much becomes viral in close to 30 to 60 seconds. There was a beautiful video circulating in the morning today, and I think within 2 minutes, it was available on at least 200 platforms. So I think the ability to duplicate, copy is very, very high, but yet each of us can go out and build some differences by doing a lot of innovation. So I think together with these three big things, which I would kind of put as the three big operating pillars as we go along for the next 3 to 5 years. Number one, cut down all excesses. Okay, while we have a right to be positive, we'll only have ourselves to blame in case we are not able to cut down the excesses and yet continue to be positive. Okay, so be positive but be cautious. Second, be ready for consolidation and therefore look out for the right partners and the right quantum of capital. And third, practically make innovation a culture in your company. Okay, we practically need to today go out and sit and have a innovation team in the company which sits close to 4 to 6 hours or even 8 hours a month in thinking through new themes, new ideas, and as a process in 3 to 6 months, it soon becomes the culture of the company. I think going forward, these are three operating principles which I would suggest we all operate on, and eventually things will look better, demand will come back, but it will not come back in a size and measure where excesses will be allowed to operate. So I would like to summarize by saying things will be better. The cycles always tend to be longer. Rationality continues to be longer. So we have to be prepared for the long haul, and small corrections in our balance sheets, in our profit and loss accounts, and our ability to be cautious and consolidate and innovate will help us be in this race longer and longer. So that's really it from my side.
Karan, just to sort of also bring you in, you mentioned earlier that, I think this whole fixed income business, this regular clip of coupon, is a facade, may not continue like that. I think there'll be more equity linked sort of structures. Can you just take another minute to highlight that?
So I think, Amit, the end of the day, investors, as together with businessmen, are extremely smart. Okay, I think at a certain price, a fixed coupon instrument for an investor makes more sense because the ability to generate a 30-35% IRR in the project from those levels doesn't seem to be real, and therefore, obviously, earning 16-18% coupon together with the entire secure entire project as collateral makes larger sense. But as a lot of these structures get unwound and the equity prices become attractive, a lot of these structures will get converted to equity structures, because after a long time, as you rightly said, nearly 6 to 8 years, a lot of these projects will end up having the ability to show a potential XIRR of 25 to 35% on equity. And that's really when it will become meaningful for investors to move their position from fixed income to equity, rather than coming in on a fixed income clip of 15 to 70%. So I think to a certain extent, over the last 5 to 6 years, even the cost of projects and the prices required to enter the projects have not justified taking equity positions. I think now we are reaching price levels where it's going to be justified. And as investors, when we put all the data on an Excel spreadsheet, we can potentially look at getting to that number, provided we come in at the right entry price. So I think we will get some capital on the equity side, and hopefully that capital is for a longer time period rather than being kind of assessed on a quarterly basis from an interest meter perspective.
Thank you, Karan. Boman, I'll bring you in now. Boman, you've been at the forefront of advocacy, of change management, of leading the industry's expectations at the highest echelons of powers that be. You've also radically helped transform the city of Mumbai and its landscape into becoming a more vibrant city. So going forward, Boman, we'd like to sincerely hear about what your snippets on the industry outlook will be, and how do you see, what are the key elements of change that is required at the policy level and at the organization level?
So thanks a lot, Amit. Highest echelons of power, etc., I'm not sure, but we at CREDAI continue to work towards getting our voice heard, the voice of the industry heard. Our sad position is that, earlier we were an industry that was continuously reaching out and not being heard as much. And today, as we stand, everybody is reaching out to the government to kind of ask for some kind of support in a way. So first we were maybe we were one of those who continuously followed up and didn't get much. And now we are one of the many. So I'm not sure what can or cannot be expected. I can tell you in a nutshell, we haven't really asked much for the industry as such. We believe that this has been, in some terms, a geopolitical event which will have far-reaching consequences. And I'm sure everyone on this panel will state that the next 18 months, if not more, could be extremely difficult. Towards that, we've tried to bring to the attention of the government that, this is where everybody has just been beaten down, whether it's our industry or basically all industries across the country, except maybe pharma and food, and that to certain production of food items, etc., which would be doing well. Real estate, in its ask of our central powers, that is of the FM and of the RBI, have been quite simple. We've said that basically this might be a good time to bring home loan rates down from 7.85 or 8% as they are to about a 5%. The idea being that this will allow people to take that call and, be able to kind of put their money down in an industry where they would be able to assist 262 industries across. So every real estate or every apartment bought or every project that we enter into supports in a way a lot more industries than most others do. If it is possible, one of the biggest boosts for most home buying would be that if they gave an income tax exemption on the asset as well as the interest paid on it. I'm saying this single move would allow them to kind of kickstart an entire home buying spree by all people who are earning money, and maybe the government would stand to lose a certain portion of its direct taxes, but on the indirect taxes, they'd make up phenomenally high. As of right now, they have a ceiling of about 2 lakhs or 3 lakhs or something like that, which is not justified. Of course, we would like to inform the government that, while a bulk of the buying is taking place in tier 3 and 4 towns, what happens is value-wise, the buying which takes place is mostly in tier 1 cities, and they make up a bulk of that value of the homes that get purchased. So they should allow this. like everybody mentioned before me, Sunil, Karan, Mohit, the industry has been going through its downturn for a long time, and as such for sometimes, let's say, less fault. I cannot say no fault, because every leader should be in a position to kind of predict what's happening for his or own enterprise. But I think for less fault of theirs and more because of circumstances, people have run up their debt a lot. Their projects are very viable, but because of the norms, because of the time norms, etc., they're not able to kind of look ahead. And I'm sure a lot of banks, and Sunil and Karan can throw more light on this later, a lot of banks wish for the one-time restructuring to become a reality, and I hope it does. While consolidation will happen in our industry, I'm sure Mohit would also agree with me, and maybe when we hear Mr. Venkatesh, he will also tell us, finding the right partner to fit the bill, especially for projects which have already started off, and we've taken on some of these projects, is extremely difficult, because you have a backlog of customers, you have a backlog of charges, approvals, the way they were taken, etc. I would hope that a one-time restructuring, at least for projects which are viable, are done, but are allowed to be done by the bankers. And I can tell you, this is not only our ask, it's also the ask of maybe a lot of our bankers who are time and again reaching out to the RBI. A very important thing, which I think the government initially taxed GST on real estate at 18%. We at that point of time had also made a representation, it should be 12%. And then this entire, how are you passing on the benefit of GST, etc., to the customers became a slight contentious issue. And somehow a structure was arrived at where we paid 5% GST for everything that was not considered affordable housing, and affordable housing came up with its own definition over there, saying that 45 lakhs was the limit of affordable housing, which was earlier 30 and 60 square meters, whether you were in a metro or not. I think these kind of curbs need to go, right? And GST by itself, it defies the principle of charging a GST without providing us input tax credit. So this is something again that we have asked of from the government. And if you let me throw up for a few more minutes, a few interesting things the government should do at this moment in time is that they should allow FDI for all ready to move in inventory, because that is capital that is available. You would allow people to, funds to make an investment in real estate, and they always have a longer term perspective. They're able to kind of put up the money that is required for something like this, and this would allow a lot of inventory to move, so a lot of debt to move from the developers and go into the hands of let's say the funds. The one thing that I would again just bring up over here is definitions need to be the same, whether they are for RBI, whether they are for income tax, whether they are for GST. And affordable housing out here is a case in point where we have definitions that vary. So it's something that needs to be done. Now, real estate needs all of this from let's say the central powers, but I think a lot can be done by the state, and I'm going to speak about the city of Mumbai. The city of Mumbai has been hugely overburdened with premiums. Ask Sunil, ask Karan, ask any of the bankers, and they'll tell you most of the amounts that a developer is paying, and Mohit, you can also add in, is towards all the premiums that he is paying, which are exorbitantly high and which have continuously just been added up, and a developer, has not been having a chance to kind of get any kind of relief out here. I think this is the apt time. The government in favor of its consumer, that is to say that if you want to do more than just talk about making homes affordable, this might be the time to say, as a one time, we will give, let's say, a 90% cut. I mean, I'm asking brazenly for a 90% cut because I believe that is what is needed by the industry. And give a 90% cut in all the premiums that you're collecting, whether as a ULB or whether as a state government. And the idea being, you will allow for this benefit to be passed on to our consumers. You will make housing affordable, a lot more affordable in the city of Mumbai. Just to give everybody who hears me, and I went through the list of all those people attending, there are at least half a dozen developers or more that I've recognized from the names. You are actually, unaware so far as a larger population that about 35 to 40 rupees that a consumer really pays goes not into the pocket of the developer, but goes towards either the state or the ULB's premiums that are paid. So what that leaves the developer with, let's not dwell further, but with 60 bucks to take care of everything, including all compliances that he kind of has to, comply with and have people to be hired for that. I think premium reduction, if there is one thing I can ask for strongly, it is that there should be a strong move by all to ask for a premium reduction. It is unjust, it is too high, and like Karan mentioned, excesses can be cut from state government as well as from the ULBs, and they can tighten their belts a little bit and take a little less money from the people. The other thing, which is very, very important, given the fact that this is a time when a lot of mergers will take place, you need to cut down stamp duty, because the stamp duty on these mergers are a huge no-go or a non-starting point. Just to give you an idea, if I were doing a redevelopment, if I have to pay 100 crore as a stamp duty just to enter a redevelopment, which is considered so that you can create affordable housing, or you can replace, let's say, dilapidated buildings in Mumbai with a better quality for those that are residing out there, which is again something that state should look at very, very strongly. You cannot have 100 crore as a stamp duty. You cannot have 6% as a stamp duty. They've reduced it by 1% now. I say they need to bring it down to 1% and only 1%. And if they do this, at least for the next 12 months, it will allow a lot of these mergers, which are necessary at this moment in time, a lot of the consolidation we are talking of. This is going to be a major obstruction if you're not allowed, if you're not given the stamp duty advantage. And lastly, the city of Mumbai suffers from land under construction charges. I want to tell you, Amit, we wind up paying in a percentage terms. I mean, a very heavy percentage, upper single digits. If a project gets delayed beyond its 3.5 years, you wind up paying close to around 8-9% of your cost as a LUC. I mean, unbelievable. And last, I would say that what we've asked from RERA is an automatic extension, because this 3 months, and again my fellow developers on the panel can throw some light on it. My personal belief, or CREDAI's belief, is that this 3 months or 2 months of a lockdown or 1 month of a lockdown doesn't mean that the extension should be only for that 1 month. We're going to have all our migrant labor leave. I have done a dipstick at all my sites. Every bit, I have 1,750 of my own labor at my sites who we are feeding for the past 37, 38 days. We are taking care of their physical, what do you call your health needs. But every one of them says the moment they get an opportunity, they're gone. And this was the season. I mean, May is when they usually leave, and they come back only around July. And, most of contractors will tell you that. And we have Venkatesh out here who can, throw some more light on that. You need to kind of give a one-time extension by at least a year, so that you save on all litigations and continuous follow-ups by a developer to come back to RERA and ask for time. So I think while I believe in what Karan has said, that the demand will come back, I don't think this is going to be a tightening of the belt only at the developer level. I think some amount of, we should be heard at the authorities level, and towards that, if there is any way that, we can get down the cost of approvals, we can kind of get some benefits for our end users in terms of home loan interest rates or income tax benefits to them. I'm just saying this will add a lot more power to, or a lot more speed to, the change that is going to take place, and that is needed today more than ever before.
Thank you, Boman. Venki, I'll bring you, Venkatesh, you've been leading development projects, not only across the country, but also in international markets. You've set up models and templates for people to espouse for. How do you see change and transformation now happening within your enterprises and within the boundaries of your enterprises?
Thank you, Amit, and a warm welcome to all the participants. So I'll talk on 3 aspects. One is a kind of view on the market going ahead. The second is what are the critical success factors for an operating partner to scale up moving ahead. And the third is, what kind of interventions in regulation and partnership could probably evolve going ahead. Now, We've had demand side disruptions in the past. We've had it in 2008. We've had it during Demon, GST. This is kind of unique when there is a demand side disruption as well as a supply side disruption. So essentially, for a developer like us, it's very difficult to predict the demand in the next 6 to 9 months. We will be focused on trying to get our projects up and starting and up to 100% capacity in the next 3 to 6 months. I think that is something we're going to focus on right in the beginning. In terms of demand, it's quite interesting because if you look at the macroeconomic environment, the interest rates are at a 15-year low. But we also have growth probably at a 15-year low. If you look in 2004, the interest rates were 8%, just sub 8%, but the growth was also 7-8%. So if you look at the macroeconomic correlation to residential real estate, these two factors play a very important role, where one of the factors is in favor, but the other is not in favor. Next year, with the base effect coming into play, hopefully with the resuscitation of demand, consumption in the economy, we probably see at least a 5-6% GDP growth rate, or probably even more. And if the interest rates can continue to stay low, I think there will be some kind of an inflection point on residential demand moving up. I think that's our broad view. So it's going to be quite challenging in the next 6 to 12 months. But beyond that, I think we remain quite optimistic and quite positive on the real estate sector, especially the residential real estate sector. The second point is, what do we focus on as a developer now? I think it is very important for us to monetize. It's quite conflicting to think that we have to monetize in such difficult times. But I think the times are gone where you're sitting on land, you're sitting on FSI, you're sitting on 100% ownership. So you need to move ahead and see how you're going to monetize and focus on the middle line this year. I think the biggest focus we will have as a company is the middle, but you have to focus on the middle line. Let me talk about some funding. If you look at the real estate cycle, up to a launch, the funding used to either come through pre-sales, that was in the pre-RERA era, or through NBFCs. Largely, in the 18 months, this is completely dried up. So liquidity for you to get to launch, liquidity for you to get through the approvals process, as Boman was talking about, pay the huge premiums, that is extremely important. And so this is actually a time where equity becomes most important. And as a company, we will want to seek more and more equity partners. But equity will also become more difficult because people will be cherry picking. The investors, Sunil, Karan, the international investors will be cherry picking. They will be looking at 2-3 factors. One is how is demand going to come back, number one. 2, what value are they entering in? Because they would want to enter at the right lower value. And the third is what are the processes, ethics, corporate governance of the operating partner and his ability to handle supply side disruption, which is going to come in. So I think equity is going to become more important than ever. Now, the third point is Mohit said, what Boman said, consolidation was already there, if I may say so, for the past year or year and a half. It's only going to increase. The opportunities for developers like us to form associations with local landowners, with local small developers is going to be there. Many of these are going to be distressed opportunities, but I think you have to be careful not to take over the distress. You have to take over the opportunity. I think that's very important for you to focus on. The government, the industry has got long pending demand with the government. The 2 lakh limit which was imposed for income tax for investment in real estate, I think 3 years back when they took it out, I think that took a lot of demand out in the market. If they get that back in, if they expand the affordable housing definition, that will really help. And the third thing is that, we have to work together in the value chain seamlessly, because what has got hurt, not only because of COVID, but also because of the tepid demand in the past 18 months, is that our entire vendor chain moving ahead, so we have to work with our contractors, we have to work with our vendors, we have to work with our customers in a seamless manner. So this entire value chain management in terms of processes becomes very important. Amit, you're on mute.
You're on.
Thank you, Venkatesh. Very, very key and very strong 3 points for the industry as a whole. I think Boman had asked these questions of you and you very aptly answered them as well. We'll jump right into Vinod. Vinod, to bring you in, a lot of questions have actually been thrown at you, largely focusing on commercial real estate. Commercial was the highlight of or the flavor of the season for pretty much last year. We saw almost $6 billion of FDI, a bulk of which went to real estate. We saw REIT. There was record leasing of nearly 50 million square feet net last year. We'd like to take your views going ahead. How do you see real estate, commercial real estate? What strategies and what evolutions do you see happening now?
Good afternoon, everyone. It's always good to be with a distinguished panel because a lot of the points anyways get covered, whether it's the good news or the bad news or the strategies, etc. Let me just give you a step back a little and give you a little bit of an insight on a general term on what commercial real estate really means for India. So you have 460 odd million square feet of grade A or any kind of graded commercial real estate that has got built in India in the last 2.5, 3 decades. Out of that, almost 300 million has been acquired by institutions. So the quality grade A assets have been largely acquired by large institutions that continue to own them. India, with the quality and the quantity of workforce, generates 4.6 million STEM graduates a year. 80% of commercial real estate is consumed for technology-driven companies. All of our worlds have continuously been disrupted by new technologies, and the way we are doing this webinar today is a classic example of that. And the need for technology is only growing, and it's going to touch a lot of other aspects of our lives going forward, which only helps building platforms for new technologies to come in, for businesses to thrive and grow. And at times like these, technologies play a much larger role. So if you take that as a starting point, and you mentioned 46 million square feet got transacted last year, between 46 and 50 million square feet, you will understand that India has put a very large and permanent stamp on the global markets for being the primary provider of technology services to the globe. While we do this, you have seen a 3-month blip, and you may see a 6-month, 9-month blip because of the COVID world that we live in, and we call it BC is before COVID and AC is after COVID. So there will be a whole lot of confusion because as human beings, we don't like uncertainty. And when there is uncertainty, all of us start thinking of doomsday scenarios, worst case scenario. Nobody looks at good day scenario and very good day scenarios. We only start working on doomsday. So we start becoming extremely pessimistic. And then we start saying commercial real estate, or whether it's residential real estate, or whether it's any other kind of real estate or any other kind of business. Are we saying the demand is switching off? No. Are we saying the demand is getting postponed? Yes, certainly. But let's understand how the technology business works. It's a serious amount of human capital. It's about intellectual capital. It's about the cost arbitrage that India provides to the world. And it's about having shown resilience in an environment like this, where globally every single industry has got impacted. It's not an India phenomenon or an Asia phenomenon. It's a global phenomenon. And if you see other countries, and you see China, or you see Hong Kong, or you see Singapore, businesses have already started to come back. China especially is now showing 60 to 80% occupancy in their primary commercial markets where people have come back to work. So we are going to see tough times for the next quarter to 2 quarters at least. We hope we can put a collar around the animal called COVID for each country on its own. And the minute you know the collar is on, then you know what animal you're dealing with. We're in between of that, and that's the uncertainty that's creating all the confusion and the hysteria and all of the stress. Long-term commercial business, I don't see it going and disrupting anywhere. Our population is the youngest in the world. We already were catering to millennials who come to the workforce. So the way we design projects, buildings, gated communities were designed for the millennials. And they are very, very differently social enabled animals than all of us. They want a lot of public spaces, recreation spaces, because they're coming out of college campuses, coming to work in offices. You and I are used to a single desk, and we don't really have any other emotional attachments to the environment around our workplaces. but the millennials have a massive demand shift in terms of how they want to see their workplace. And that's already driven by the new designs that we build our large workspaces by. And those people want to get back to work the minute the fear subsides and the minute you start getting either agitated, irritated, where most of the people we see are already wanting to step out. The other important thing is, because of the work from home, which everyone thinks is here to stay, I have a different view on that, and I'll step onto that a little bit later. What's really important to understand is that whether it was work from home or whether it is working from marginally occupied offices physically, or whether it is doing remote working, etc., the bottom line is that you have been able to provide services. And if you're able to provide services, all of those companies have continued to earn their revenues. And on the flip side, they've actually tremendously saved on cost. Because if you take real estate as a cost of their operating efficiencies, real estate is between 4 and 5%. When I say real estate, I mean rent. The residual is really 60% is human resource and all the other support infrastructure factors. So if you translate in most cities, larger cities, 25 rupees odd is just the transport cost to move people around. Between 25 and 30 rupees is the power cost per square foot that a consumer is paying sitting inside his office. A lot of these things, which mean that can I, as an individual, afford to pay all of those things, keep my air conditioner on in a paying guest accommodation for 12 hours in the day? Can I pay a 2,000 rupee Wi-Fi bill to be able to service work from home? Can I manage cyber security from home? Can I have backup power if power just switches off in my household? All of these things suddenly will tell you that technology companies have to get back full-fledged to working from organized environments. Yes, post-COVID, certainly things will change at the workplace, and we're actually already put protocols in place because we want each of us, when we go back to work, to feel really safe. You're very safe at your home. When you step out, there'll be fear. You want to step out in an organized manner and reach your workplace and feel very safe again. The minute that safety net is provided, you will see people get back with aggressive manners to reach workspace because they know productivity is coming from there. And that's not changing in a hurry. You might find 10 or 20% work from home as BCP. It's not a new thing. Companies have tried that for the last 10 years. So it's not something that COVID has taught people to do. This was the need of the hour. People stepped up to the need of the hour and have continued to deliver. So I think if India continues to deliver services, it will become a far more dominant player in the years to come. Obviously, demand drivers are going to drive this business. So if demand slips in America, you will see a slip of demand in the short term to come back into India, because 80% of the tech force jobs are catering to the US economy and the European economy. But in a weird way, they don't have STEM graduates to that volume and degree, and they don't have human resource. Any one of these countries don't have. They will have to be dependent on India for more services and more deployment of capital to actually bring in better technologies. So if we take that news forward, of course, as a learning for all of us, the gap between strategy and execution has to change dramatically. You strategize in the morning, you'll be wanting to execute by the evening, and you'll be strategizing tomorrow. So that's a big change all of us have to grapple with. And that's where actually you will differentiate yourselves. Certainly consolidation has taken place in the commercial world. And you have top 10, 15 players in India who have consolidated and created a position for themselves where they can kind of bring in quality supply year after year. Fortunately or unfortunately, because of that organized play already taken place in the grade A commercial office space, you will see a very large elasticity in terms of supply going down dramatically for the coming 12 months to 18 months. So even if we say, let's assume that if 46 million square feet was consumed last year, are we saying it will be zero this year? No. Even if we say it's a 50% demand, I think it should be higher than that, but I don't want to give any projections. So you assume 50% demand goes down. You still have 25 million square feet getting occupied. And you're not getting 25 million square foot built and delivered in 2020-21. Because construction projects have moved minimum 6 months to 12 to 18 months. So I don't think there's going to be, while the uncertainty is there, and we are going to obviously think about all of these aspects, 6 months to 9 months from today, you will see businesses come back. The last thing I'll make is that the GICs, which is the global insourcing centers, started off aggressively in India 5 years ago. Today, 20 to 30% of the workforce is working out of GICs. When I mean GICs, they are global insourcing centers. So companies have set up their own offices, which are front offices, where their own logo and branding is put on those buildings. They're no longer third-party outsourcing shadow boxes. They want the same lifestyle, the same environment that they give globally to their employees. And that's what they are now doing as front offices in India, supporting their global offices. So there it's a cost arbitrage game. So suddenly the dollar dropped by 10 to 15%. They've gained 10 to 15% in savings straight away in the 3-month period, which nobody was anticipating. So all of these factors are going to drive more of these things to come to India in the short to medium term, for sure. Yes, there will be capex issues that they don't want to renovate their offices in a quick way. They may delay the capex expenditure for 6, 9, 12 months. But I don't think technology-driven workforce is changing from an India positioning point of view. I think it's only going to get stronger. With that, I'll end.
Thank you, Vinod. I'll just jump back to Mohit, and Mohit, a few points have been made, by all our friends today morning, and some of them have a lot of common threads, including what you mentioned. But there are two things that I would like to sort of face off with each other. The first is, there's a very clear message being put out first by Sunil saying it's not about land, it's not about land bank, it's not about FSI, it's not about the size of your asset base. It is about how efficiently you're able to actually convert it to cash. Venki also talked about monetization. Karan mentioned about how it's important to consolidate, look at cutting excesses. So do you think the next wave of consolidation is going to be more asset light for you? Or do you think there's an opportunity to actually look at acquisitions and continue the M&A spate like Boman mentioned, because you're getting into cheaper asset at better quality or better opportunities available to you? So what is the right way forward for you? I mean, are you looking at more capital intensive strategies or more asset light strategies? You're on mute, Mohit. Yeah.
Sorry. Can you hear me?
Yeah, good. Thanks.
Yeah. So, first of all, the way I look at, real estate business, residential real estate business, is I look at it in 3 parts. The first part is there is a land business, there is a development business, and there is a capital business. Now, if you look at, players like ASK, IIFL, and many other players are, just participating in the capital business. Historically, we had people in the land business who moved up the chain and took the development business, but I think there is going to be a disaggregation and more focus in each of these categories. Now, if you look at development business, I fundamentally feel it's very close to an FMCG kind of a business, because at the end of the day, it's a consumer business. So the sales and the understanding of customers become the most dominant element for a development business. Now, if you look at us as a business, we actually operate in both the development business, but also in the the capital business, both by having a very strong balance sheet and prop money, and also with our own third-party funds through our Godrej fund management platform. So that's the big picture. I think we need to understand, because there is otherwise we start seeing a lot of people used to just say there is an underlying value in land, but I think there is an understanding that there is actually a completely different business called development business, which has its own value, which could be independent of land actually. Now, if you look at our own strategy, see, we have close to 2,500 crores of cash sitting in our balance sheet, which we want to deploy for growth. So we are obviously, and we have been, quite aggressively growing our business over the last few years, adding almost 10 to 15 projects annually over the last few years. Right now, the period of uncertainty is very high, but, once things stabilize, once, we are back in offices and, we feel that there's a sanity which has started to prevail in the overall market, we understand what is this situation going to be, we would start deploying capital, and we will be very happy to partner with other players, create win-win partnerships, both with the existing erstwhile developers and also with the fund partners. I think it will be important to now come up with a win-win across 3 parties for it to be a sustainable partnerships for all of us. But I personally feel, Amit, I'm extremely bullish as an organization, as an individual, um, of the opportunity at hand for us as an organization and some of the other players as well.
Sunil, I'll jump directly to you. Sunil, I'll jump directly to you now. And I think there are a couple of very critical points that are being asked. I think, first, of course, is the type of capital formation. What is going to entice or what is going to motivate or drive fund managers going forward in terms of dealing with their stakeholders, creating new capital partnerships and structures. Karan alluded to the fact that there could be a transformation from debt to equity capital. People will need to see, obviously, commensurate returns. Also, what are the confidence building strategies that you think that need to be deployed by you, by the industry at large, both financial services and real estate, to be able to espouse the confidence of both the consumer, the investor, the developer, as well as the buyer on the street? How is landscape therefore going to change for everybody going forward? And maybe some quick data points that you may have, Sunil, as to how the right organizations with the right motivation and the right structures are able to continue to perform, despite these challenges. We've already got some fantastic data points which Mohit has kindly shared about how sales could have happened in the last 15 days. So clearly we need to see the path forward from an investor's perspective. There's a lot of cloud, there's a lot of confusion in investors' mind. Is my investment safe? Where am I going to invest? Is gold the only opportunity left for me?
I think, Amit, thank you very much. And I agree with every panelist about the summary what we have done for last 1 hour. I think the biggest thing is that the moot question is whether it is the home buyer, whether it is the bank, or whether it is a private equity fund, or whether it is the individual investor who would like to buy second and the third home. Where will they focus on? And I think that's the moot question, and that is very, very important. Now, consolidations would happen for their reasons, but the quality of the product delivery will never go away. Okay. Second is the completion confidence and a quality delivery confidence to the home buyer, the investor, or the bank, or to the private equity is not going to go away. So it is important that each of these stakeholders who are relevant at this point of time for a demand revival and a capital provider need to see that your cranes are moving post-COVID. The biggest thing is the cranes should move. That means you should be in a position, whatever time it may take a 2 month or 3 months or 4 months where your workers will be back, but the crane, the home buyer should get a confidence that he will get a delivery of his home, and he visits the site, mind you, every week, every month, and sees that the progress of the work is, and that is the most important trust he has to build. Today, there is a complete distrust between the stakeholders amongst whether it's the customer to a builder, whether it's the customer, whether a housing finance company, a bank to a builder, is a fund to a builder. We need to restore the confidence amongst each other. We need to build the trust amongst each other. I think it's more important that the customer, the investor should feel the price value gap, the price I'm paying and the value at what I'm getting, whether I'm buying a home or I'm doing an investment, should be win-win, and that is the most important thing. So what is that private equity investors are going to look into those developers who are going to survive? Now, everybody is not going to survive is a reality. People will do partnerships. People would do joint ventures. People probably would go to the larger ones, branded ones who can get capital to them. That's all fine. That's all history. That would have done last year. That the journey is already started, and I think Corona only accentuated the pace at which the consolidation will happen. And that's where I said in my opening remark, the size and the quality is going to be the predominant theme going forward. So as a private equity, you would like to see how are you changing? Are you, during this period, change your organization to a technology savvy organization? Do you have a 3D models available where you can actually send it to your people who have visited you, the potential customers? Have you explored the possible opportunity of opening up your channels, digital channels, online channels? Do you see there's a cost which probably was increased from 2% to 8% of the sales to the intermediary in between, a broker in between? Can that cost be restored much lower? Can you sit back and design your product with an optimal cost? And as all of the panelists said, this is a time for war on waste. So I think it's very, very important that the confidence the actions given by each of the stakeholder or getting from the developer is so important at this point of time to really see there is an opportunity post-COVID. My view is at this, as capital, I don't see really a problem, because as there are certain things which are beyond the scope of each one of us here, but there is a government who is going to play important role, and I completely support the restructuring to the viable real estate project. I also, if I would have been the finance minister, I would have relooked at one part. I would have convinced the states to reduce 50% of the stamp duty, registration, and all the premiums to be paid by the projects for next 2 years. I would have definitely looked at GST, but with input tax credit. I clearly would have looked at opening up the capital gain opportunity for real estate as an asset class. Whatever capital gain each one of us can have, can put back into real estate, second home, third home, fourth home, whatever it may be. And the multiple home buying opportunity, so that you can take the income from house property as a negative carry, because there is a exciting yield and there is a interest rate gap in between. So these all are not really putting the treasury stress on the government, because these are all non-cash items. Restructuring is a non-cash item. Reduction, because this will stimulate the demand and everybody will help. So my view at this point of time is that most of the developer fraternity who probably would change aggressively, actively, digitally, they would be optimizing the cost. They would be focusing on the customers quite well. And it is also a reality that in this period, you can easily expect the customer, the investor, private equity is going to be much more risk focused. They would seek for more control. They will be monitoring the projects very closely. And I think one should not hesitate and feel bad about it. And let me give an example. I have live examples of some of the developers who probably have done very well. And I think on this panel itself, I think Mohit has shared this wonderful news. I would like to share some of the good things happening in some cities like Pune and some cities like Chennai, where I could see, and in Bangalore, I could see that during this period of 30 days, some of our investing companies who probably have done a lot of these things with a lot of collaboration with their team members, the technology teams, and some of the support we have also extended to them. We could see that we could able to get 23 sales in apartment, 23 sales in plotted development. We could see 125,000 square foot got leased in Pune with a very good lease rental. So this all clearly means there is definitely an opportunity. The underlying demand is very strong. What we need is we need to focus on what we have in our control. And the times are tough, but tough time only the good business model evolve. There is an opportunity for innovation. There is an opportunity to realign our thoughts to the new reality rather than sulking. And that's where I said, Corona. This is a time for action. This is a time for being proactive. This is a time for taking a decision. At times, a decision may not look very attractive because one of the project, we may have to reduce the prices. Some of the project, you will not make any profits. That's fine. But at the same time, you will save your reputation. And as I say that you have, the reputation is the single largest asset, which will get you your home buyer, which will get you a banker, which will give you a private equity, and you can really make the beautiful partnership with each one of them post-COVID, is what Amit, I think at this point.
Karan, I'll very quickly come back to you again. You give a very, very wonderful, crisp three-pointer on what needs to be done by any industry leader. Having now just to sort of drill down a little more, there are two specific things which are required to understood a little better by all of us. Well, first, Sunil and Boman both alluded to the fact that it is very critical to look at restructuring or one-time loan restructuring. But what is the scenario with the NBFC space? Do you think there's an opportunity there also with global or local capital to look at long-term solutions within the NBFC balance sheets? Second, is it possible to take, a lot of banks have been able to convert their debt into equity. You think there's a similar opportunity for NBFCs, as was rightly mentioned by you, that if there is commensurate returns, then there is an opportunity to look at equity. You think there's an opportunity for NBFCs or even a possibility for NBFCs to look at more equity-like structures despite being lending platforms. So I'll pose as that as the first question for you. And the second clearly is that are there new avenues of capital that you see coming through? Pre-COVID and post-COVID, there were bond markets, there were other markets. India may or may not have been in the focal of every investment strategy, or real estate may not have been. Do you see any tectonic shifts in terms of realignment of portfolios? So 2 questions quickly for you, Karan.
I think, Amit, both the questions in some ways are linked to each other. I don't see NBFCs actually converting their loan positions to equity, even if they are provided one-time restructuring opportunities, because the way banks and NBFCs are structured and the way the listing requirements and the quarterly reporting requirements work, I think it's next to impossible task for any large listed NBFC to start converting its loan positions to equity. But I think, as I was saying earlier, I think at the end of the day, wherever there is a good governance and the cost of the project is right, and the probability of a good economic profit is high, I don't think so eventually there will be lack of capital. I think there's abundant capital across the world, and capital finds its way into the right set of corners. The structures might differ. It may not necessarily be an NBFC vehicle. It may be a combination of the right alternative investment fund schemes. It may be the right LPs who will come in. It might be larger funds which have the ability to stick with you for 10 to 15 years, but might want to take strategic equity stake in the business. It'll be a combination of all of these. I think NBFCs and banks may move away from the stage of giving seed capital or initial capital to some of these projects. It may end up coming in a much later stage. I think as an industry, for real estate as well as developers and all of us, I think the first 40 to 60% of the groundwork before it really becomes close to a cash flow kind of discounting situation, a large part of that will have to effectively now start coming in the form of equity. It's going to be unlikely for NBFCs or banks in the revised format to be able to facilitate a large portion of that. I think there is enough amount of capital. It's just that the right structure and the right economic profit needs to be there. And I think that will come in. It's not something which is impossible. Will it come through the current NBFC structure? I don't think so. And I think the NBFC crisis also will require some NBFCs to potentially restructure the debt, like some banks have done it one time. But getting all of it converted to equity may not necessarily be the right solution.
Coming back to you, Venki, there's always been a mindset that large corporates tend to be less nimble. You talked about monetization strategies. There's been a consistent theme about speed, about innovation being the need of the hour, how strategies decided in the morning need to be implemented by the afternoon, and again rethought the next morning. What is it that you think will need to be avoided going forward, as men have become boys, and and those as boys have become men, and men will now need to become giants as consolidation accelerates itself? So as one of the people who are expected to become the next giant, Venki, what is it that you need to do to be more nimble, to be able to and be cautious at the same time? What is it that you're thinking from a strategic perspective, and how strategy going to convert to tactics for you?
No, I think it's very important to have a measured scale up. So, Shapoorji as an organization has been a B2B organization. This is a B2C business. So the mindset, the processes, the decision making has to be completely different in terms of attending to the various volatilities which come day by day. So over the last 4-5 years, we have built that entire development framework in terms of the people, processes, etc. And we are quite agile right now to move ahead. But the point is that there will be more and more projects coming up once the market picks up. How do you scale up? And you have to have the right balances between processes and decision making. If you have processes which are just going to be there, not allowing you to move ahead and take decisions, which is very much required in the real estate sector, because day to day you take so many decisions. I don't think you are going to be able to scale up. So the agility will come with the right balance of processes and decision making. The second is that we have seen in our organization is that the institutional partners actually get a lot of these tenets to us, whether it is agility, whether it is taking the decisions, whether it is the governance. Come what may, we developers overall are slightly disorganized, and having the right context in terms of an institutional partner brings about the best in terms of how to go ahead with the right processes and go ahead with the right decision making. So also whom you partner with, whom you associate with, what actually rubs off with your brand, etc. is extremely important, because it's not only your processes, your decision making, you have to integrate it with other people. You have to integrate it with your contractor. You have to integrate it with your investment partner. You have to integrate it with your co-developer. So how you're going to integrate that is going to be extremely important, Amit, going ahead.
I understand, Venki. Thank you so much. I'll again very quickly come back to you, Vinod. You alluded to the fact that commercial real estate demand is likely to be consistent, however, albeit with certain change norms in terms of working at the work environment. Do you see a similar outlook for retail as well? We talked about how efficiency will still be there at the workplace. The landscape changing. Malls are likely to continue to be shut for some time. You're also one of the leading developers and owners of a very large retail footprint.
So I can't officially comment on retail as a business because it's a separate vertical run by a separate set of professionals. What I'm seeing globally, and I'm seeing China come back, and the retail malls have opened about 30 days ago. And we're closely watching those, and you're seeing consumers come back. So if some statistics were to be summarized, 50% of the business is back, with 50% of the population coming back to malls already in the large China malls. So we would have thought that in any case, in a market like China, where e-commerce is far, far more penetrated and established than it is in India, even after that, if you see 50% of the malls getting 50% of the population back, it's a very big number to start with. We don't have that kind of e-commerce depth yet. E-commerce is really going to grow in India, but you will have the other alternative will be to go back to retail formats. Let's ask ourselves the same question as consumers. You may not go and crowd yourself on a Saturday and Sunday. You're sure what you want to buy. You will go in the non-peak days. So suddenly you'll start getting business, true business from a Monday to Friday, because you will go there and pick up what you need and come back. So in a weird way, you might balance out the population densities suddenly spiking up on the weekends to actually consumers coming during the weekdays and buying what they want and going away. It's very simple. If all of us were given, all consumers were flashed with the news of 50% sales opening up for the festive season, and you prepone the festive season, you'll have huge number of people running to the malls. Then the problem will be to control how to reduce population to come to that mall. So it's a mindset framework change. All retailers will program and design methods of getting consumers back. And I'm sure all entrepreneurs in India and all over the world are really smart, and they know how to attract their consumers back. So I would be not as bearish on retail coming back. I think it's a 3-month, 4-month blip. Let's hope things come back quicker than what we anticipate.
Mohit, I'll come back again to you. There have been a lot of questions we're getting from, a huge segment of our industry stakeholders, right from fund managers to some of our other industry leaders and colleagues. One of the questions really talks about affordable housing and its mix and its impact on the profitability as well as on the growth for any enterprise going forward. Your views, you deal across, various segments of the housing space. Do you think affordable housing will have larger dominance or the mix need not change? I think that's the first question being asked. Second, do you see that price to be a continued determinant, because you've clearly broken the mold when it comes to creating the right product at a price point that still is being absorbed by the market, but you see a new normal in terms of price or design? So these are the two questions being directed for you.
Thanks, Amit. So first of all, see, we as a company, believe our strategy is to be dominant in the mid-income segment. So we would like to, focus almost 80% of our projects to be in the mid-income segment. Few projects we are doing in the affordable segment and few are in the luxury segment as well. But even in the affordable segment, Amit, the way we are defining affordable is, with the ticket size and the size of the apartment, not really affordable from a, price point perspective. Like, we are not really playing in a sub 4,000 kind of a market because, given our cost structures and given our organization structures, we won't be able to run a profitable business in those price points. But, affordable with the, 60 square meter size and a 45 lakh square feet, 45 lakh ticket size is an area which we have been focusing a lot. And, we have seen very big success in Pune projects, in, Bangalore projects where, these price points and these ticket sizes start matching. So that was your first question. I think the second question was more on pricing.
Pricing and design both. Yeah, pricing and design.
So I always believe, on one thing, Amit, that, we are a consumer business. And the first thing you learn in a, I've started my career in Unilever. And the first thing you learn there is it's not price. It's a price and value. And unless the price value equation is right for a brand or a product, it never sells. So I think I have always remembered that one thing which was taught to me. And, this is something I always ask whenever we are launching a project, that, what is a value proposition for a customer and why should they buy it? Now, if the value proposition is strong because of the product, because of the design, because of the amenities, because of unique features you are providing, then people pay value. Now, let me give you examples. And these are not marketing gimmicks. When I say value proposition, it is you need to have a reason to believe in the product if you're marketing. So let me give you an example. We have a product called Godrej Air, which we have launched in Gurgaon and also in Delhi. The value proposition is that we will provide clean air inside the apartment, and also we took it up to say that within the complex you will have clean air. Now, if you look at Delhi, now of course with the COVID, the pollution levels are good, but Delhi historically and NCR historically has been really struggling with pollution, air pollution. So if a project comes in and promises clean air both inside the apartment but also outside within the apartment, I think it's of course you have to spend money behind it, but it's a huge value which you're providing to the customer, and there are customers who would be willing to pay a premium or a slight premium for that value. Similarly, we had a project called Godrej Aqua in Bangalore. Now, if you look at Bangalore, the number one problem there is water. So, our promise was that, our first goal was obviously to do 100% water self-sufficient development, but the cost was prohibitive for a mid-income segment. So our promise was that, the number of tankers which are required will drop by 70% in this development. So we had to come up with this solution. And of course, it's been a huge success. So, every project of ours starts from what is the customer need, which needs we can solve in a particular project. How much is the customer willingness to pay for this, and then eventually launch it. So it's a very different way of operating. I mean,
what you're saying, Mohit, is that the value proposition will continue to be the demand driver. It is not necessarily price. You don't see how price cuts or any price impact will actually, take away or increase or decrease demand. So it has to be more customer centric.
I think it's a price and value equation, Amit. If your product is not great, then price drop is the way to bring price and value in proportion. If the product is very good, then you can charge a slightly higher price. And customers are willing to pay for it.
Right. Sapna and the rest of the panelists, I know Mohit needs to also drop off in a few minutes. If there are any questions that we can have would be directed at Mohit, because, I've tried to take some of the questions that have been sent to me. And
Yes,
then I'll
I'm
go to
sure.
Venki to ask similar questions.
Yeah, most of the questions I'm sure must have been answered in the discussion. There is question from Mr. Pradeep Agarwal from Signature Global for Mr. Sunil Rohokale. He asks, what's your point of view for low cost housing, 20 to 40 lakh segment?
You're on mute, Sunil.
Yeah, thanks, Pradeep, for the question. And I personally feel if you have to put the sequencing and dare to forcefully fit the sequencing of recovery of real estate, I think the first and the foremost is going to be the affordable first time home buyer market less than 50-60 lakh rupees. So it would be 20-25 lakhs, it could be 40 lakhs, it could be 50-60 lakhs. That is the first asset segment I think in real estate would see the positivity and improvement. The second probably would be the 60 to 1 crore category probably will follow. Then I feel IT spaces would follow. Then I see the office spaces will follow. Then would be retail, and the last will be the luxury, which is 2.5 crore. So I have put myself into spot by forcefully putting that into sequencing. So coming to Pradeep's question, affordable housing, though the definitions are varied in the minds of everyone, but the fact of the matter is the first time home buyer, the new to home is called as affordable housing. So anybody who is new to the new home is affordable, and that starts with 20 lakhs, 15 lakhs, depending on the location. So I think I see the recovery much faster, much earlier, provided the quality of that affordable housing is being considered. And I see a potential threat for Mumbai, that opportunity of slum redevelopment is completely going to get lost. So your natural supply is going to come down because government, I'm sure, would be relooking at the redevelopment of slums in India. They apparently at times look affordable when they sell into open market. But I think all other cities, the first to home buyer market looks to me very attractive, and I have a positive view on that.
Okay, fantastic.
I'll again go back to Mohit. Mohit, there was a recent comment by Mr. Nitin Gadkari on one of the interactions, as well as Mr. Hardeep Puri, saying developers need to build more internal resilience. They need to have the entire supply chain integrated within themselves. You alluded to the fact that you have pretty much created most of these blocks within your organization, whether it is a housing finance company, a private equity company, a development company, a landowning enterprise. Do you think that resilience on more internal assets and internal, supply chain blocks will continue to be the focus? Or as we've been talking about creating extended partnerships, or partnerships will be the fourth? Where do you think? More internalization or more globalization and partnerships?
Yes, sorry. I think resilience, in my mind, I'm looking at it differently. I think resilience has to be in terms of balance sheet and brand and ability to absorb shocks, which are anyways part of our industry. So I think that is an organizational call which each of us have to take for our organizations. I think it's a good lesson for everyone that over leverage is also a dangerous place in development business. But I think overall, if you ask me from a supply chain and industry dynamics, I personally feel that our industry is going to be led by partnerships. Globally, it is led by partnerships. There are very, very specialized works. Construction is a very specialized activity. Real estate development is a very specialized activity, and land business is very specialized activity. Architecture is very specialized activity. So I think there will be specialized people, and there will be a lot of partnerships. And I personally feel that is the way forward for us even now.
Mohit, I know you need to leave. You have a meeting at 1. Is there any sort of closing or quick comments or views that you'd like to share with us? And there are a number of questions which are waiting for the other panelists, which I'll take on from there on.
Yeah, first of all, thanks for the invite. I had a real pleasure, interacting with all of you. I would have loved to take more questions. Parting remark is, let's be ready for the pain over the next 6 to 9 months. I think we should be staring at the reality with, these tough times with reality. But I think if you look at a slightly longer horizon, we will bounce back. And I personally quite bullish both in terms of Indian economy in the long run, and of course our sector. I'm particularly bullish on residential real estate. So maybe 2 years down, later when we look back at this event, it could be the turning point in the journey of our industry. So I'm quite bullish and optimistic. But yeah, couple of months of pain.
Thank you, Mohit. It was a pleasure having you today with us. You've been very candid and you've shared some extraordinary insights into how you prepare yourself. You're preparing yourself the last 2 weeks of your journey as an organization and your outlook. I think that's really going to set the tone for many of us within the industry as to how we behave and how we see ourselves, on the other side. So thank you for being around.
Thank you. Thanks, everyone.
Thanks
with
for
us.
your time.
I'll quickly jump to Venkatesh. Venki, you've been also one of the leaders when it came to affordable housing.
Sorry, Amit, I'm not able to hear you.
Yeah, I have a slight slow net connectivity. Can you hear me now?
Yeah, I can hear.
Okay, yeah, sure. Venki, you've been leading, with a platform on affordable housing. Your backdrop also mentions Joyville. People have come to recognize and appreciate the brand. Pradeep asked about what do you think in terms of the whole mantra for affordable housing, because it is a thin margin business. It requires better efficiency, better turnaround. Do you think that continued strategy on affordable housing, especially the price bracket that he asked, will continue to be a dominant product allocation or part of your portfolio, or do you think we'll need to reconfigure the development mix going forward?
Yeah, I think you have to break it up into two parts. One is the 10 to 20 lakh housing, and then maybe the 25 to 60 lakh housing, which is the more middle income MIG kind of housing, which Joyville represents. Now, as a firm, we are extremely positive on both the segments, both the 10 to 25 lakh as well as the 25 to 60 lakh. The demand in the 10 to 25 lakh housing would be the highest, needless to say, given the ticket size and given that most of the population at this point of time, given the urbanization, the age, etc., will have the buying power to purchase a 10 to 25 lakh house. There are two more things which you need to kind of contend with. One is the cost, because unfortunately, the lower the ticket size, the lesser the margins, because your construction costs, etc., do not move in the same proportion. We have to build houses without actually building parking. You have to build open parking. You have to build houses in stilts. You have to manage to give more space within the compact house. So design, technology is extremely important for you to manage the speed and the cost in affordable housing. So that is something to contend with. Now, Shapoorji, Pallonji being an integrated player where, we have a division which does our contracting, we have a division which does the design and build, we have a division which does the MEP. I think we feel that if we can integrate all our franchises together, we will be able to optimize the cost across the value chain and mitigate to some extent the risk of lower margins in the affordable housing segment. And at the same time, you have to do this business in scale. If you're doing only a few projects on this and not having a context of building a large business on this, I think then, in my opinion, it doesn't make sense. So if you want to do this business, you have to do it in scale. The scale will actually more than compensate for the lower margins, which would probably be there in this sector.
Sunil, I'll come back to you in a minute. I have a few quick questions for Karan. Karan, there've been also, a new emergence of, not really new, but, we talked about how Vinod mentioned that 50% of commercial real estate or more of grade A assets have already been bought by international or FDI investors. A lot of focus was there in the past in terms of buying free leased assets. Do you think that with the reduction in the interest rate environment, we're looking at very, very low interest rate regimes going forward, there will be a flight of capital to core plus strategies by even the HNIs, by family offices, by LPs, both domestically and globally? Do you think that will become a new investment asset class? Also, we talked about, if the regime continues to sort of be in the negative term lending rate category, then we might actually see the spread between the yield on residential as well as on the home loan actually come down substantially, which do you think will then make also leasing and buying real estate for leasing become an attractive investment asset class going forward?
I think on the commercial side, Amit, I wouldn't venture as much as to say that there will be a demand and flux of money pouring into the commercial real estate structure. Even if the yields are attractive around about 9-10%, I think what people are really questioning is change in demand. I don't think so. There is not so much price sensitivity that with the change of yield from 9 to 10%, it becomes a dramatically much more attractive investment. I think people will wait for the next 3 to 6 months to try and see whether there is some bit of stability in being able to predict the demand of these kind of office spaces. So I think it's not only going to be about the yield, it's also going to be about a little bit of steadiness in the market. I don't think investors and buyers are that sensitive to yields. I think the right yield levels may remain between the 8.5 to 9.5 levels, but they'll have to wait and see a more steadier market before they can come in with large amounts of money. On the interest rate side, I think Boman made some, on the residential side, he made some really interesting points. I think if we can get a tax exemption on the interest on housing loans, that effectively even a rate of 7.5-8%, what it is today, effectively drops to 5-5.5% post-tax. If you can reduce that by another 100 basis points, suddenly owning a house at 4% or 4.5%, post-tax yield will, post-tax interest will become interesting, because a large part of India today is essentially paying a residential rent yield of 2.5-3%, on which they get a tax rebate of close to 30%. So effectively makes it 1.5-2%. On the other side, today a home loan costs you 8%. So the gap between the 2 and 8 is too large to justify going and buying a house for a new age millennial professional today. Hopefully, the 2.5 can move to around about 3, and with a little bit of tax swaps and also the interest rates coming down by 100 basis points, if that gap can come closer to each other, I think that may end up stimulating the demand much more. And as an early, as a person who starts just working today and I'm looking to buy a house worth 40-50 lakhs, I think the decision between renting and purchasing will become much easier, because today, fortunately or unfortunately, on my rent, I pay for the house, I get a full 35% tax deduction through the HRA, but the same exemption is not available beyond 2 lakhs when I go out and purchase a house. So I think on the residential side, a little bit of tweaking in interest rates, either directly or through tax mechanisms, is extremely important for demand to come back. On the commercial side, I would rate a little bit of steadiness in the market as the first parameter, followed by the yield. It's not going to be the yield then leading to stability, because if people are not sure about the demand itself, 100 basis points here and there is not really going to drive the decision.
Karan, we've already seen a certain flow of, or a directional flow of capital. It is said that capital is likely to first go, and I was listening to one of my friends on one of the other webinars, with me a few days back, and he said it's likely that global capital or even domestic capital will first fill the equity or the listed equity opportunities, because there's a lot of value pick that is potentially still available. I don't know if that's true anymore. The market has already run up by about 26 lakh crores. The next would potentially be on the credit side, because with interest rates being lower, there's a possibility of new credit capital being afforded or available to large corporates or highly rated corporates. But then again, there's a talk about how, it's not just about yield, and you talked about yield and how yield post-tax is so relevant, but there's also a lot of talk about flight to safety. and gold being one of them. So is real estate that asset class, or will it emerge as an asset class, in the medium to long term, where people will see it as a flight to safety rather than returns, because there have been concerns about other financial assets, in the current environment?
So I think generally speaking, now investors are much smarter than what they used to be a decade back. I think investor education's really come a long way. I think people are able to distinguish, broadly speaking, between liquid mark-to-market instruments and illiquid non-mark-to-market instruments. Real estate, to a certain extent, would come in the illiquid category. On the liquid category, I think people are not only looking at returns itself, they're also valuing a little bit of anytime liquidity. Okay? As far as equities, even a large portion of the fixed income instruments go, you might have a little bit of fluctuation in the mark to market, but there's definitely liquidity available at all points in time. On the real estate side, sometimes liquidity can end up being a challenge, but I think there is enough capital for both. I don't think so one will end up substituting another. What will happen for sure is money will get invested through more formal channels than informal channels. People would want to see their money and capital safer. In the really short term, which is the next 3 to 4 months, I think the risk aversion will be extremely high. We've seen scenarios where clients really don't want to even kind of go out and invest in debt funds. They want to be practically in Government of India GSECs, tax-free bonds, potentially even fixed deposits in some cases. But that risk aversion is going to continue for the next 2 to 3 months. But once things settle down, I think there is enough capital for all three. And I honestly don't think that for real estate to get the right amount of capital, it has to substitute fixed income or equity. It by itself has to become an attractive enough proposition, and there is enough capital available. So it's not as if it's necessarily going to take away from something. It's just that people will end up being under allocated to real estate as time goes by. And I think over the next 6 to 18 months, once there's good stability in the market and people are able to broadly predict the outcome, I think people will have the appetite to go and buy real estate by itself, irrespective of how well the fixed income markets are doing. I don't think so it's going to be a either or kind of situation.
Fantastic. Thank you. Sapna, before we let Karan go, are there any questions that the audience has for him? We've been getting some fantastic poll results. Also, I'd like my fellow panelists, many of you already have worked or interacted with Karan here as well as earlier. For the benefit of all stakeholders, are there any questions that we can direct at him?
No, I think all the questions that we got, I think they got covered in the discussion that you just had with Karan. Thank you, Mr. Karan Bhagat, for your time.
Thank you, everybody. Thank you.
Thank you so much. We do have questions for Mr. Boman Irani and Mr. Vinod Rohira.
Yes, please go ahead.
Okay. For Mr. Boman Irani, we have this question from Chetan D. Narayan. He's talking about foreigners investing in Indian real estate, and should they be allowed to invest in property with proper exit policies, holding of property for 10 years to generate cash flow for real estate and tax revenue for government?
So I'm just trying to address the unsold inventory that is lying around over here, where developers are going ahead and paying heavy interest rates, trying to manage the debt. Towards that, there's FDI that's available. That is money that can come in over here and pick this up, thereby reducing the debt on the developers itself. And I think these investors who come in will have a ability to hold on to these assets and even increase the rental housing, which is going to be made available or to be made available to the people at large. And this would help the government to take care of its problem or take care of its need of homes for all, because not everybody might want to go out there and afford or buy a home immediately, and we might not be in a position to give everybody a home also immediately in that price segment.
Boman is an extension to that question, and I think there was an earlier question which had been asked of you. Mumbai is largely perceived as an unaffordable city. A lot of comparison is made between Shanghai, New York, Mumbai, and how Mumbai on a GDP per capita basis is one of the most expensive locations. Do you think there is an opportunity to unshackle that? Of course, you talked about how 40% are government dues, and clearly that limits your ability to do things. But is affordable housing still the way to go for you? As the next wave of development and transformation. Second, Karan alluded to the fact that, if there are attractive returns enough in the sector, there is enough capital and there's enough equity that will form its way towards the space. So clearly there is on one side a dichotomous situation where you're looking at larger returns or sustainable returns for equity investors. On the other side, we're looking at thin margin, large scale, affordable developments. Where would your verdict lie? Where would your strategy lie?
So, I would say that it's all going to be about how our state leadership views the possibility of reducing the premiums. Let me tell you why these things went out of whack. Because there was a time when everybody thought that real estate is a very juicy, fruit. And without realizing the pains and the perils that lie within, they entered the industry and they kept on bumping up, let's say, the overall cost by paying, even in redevelopments, giving unreal areas or amounts to the societies that were being developed. Now, when that happens, obviously everything was perceived to be a perpetually rising graph, and now might be the right time for all of us to realize that a lot of these players would go out of the market, like Sunil mentioned, like Mohit mentioned, and there will be a lot more consolidation. So the right mindset and the right development skill will come into play. Mohit also alluded to, real estate being three parts, where there's land, where there's development, and where there's capital. So I think coming together and the right mix, I think Karan mentioned that, it's a strategic investment or buy-in that you require from funds. Let go a certain amount of your equity, share your profits, and then go ahead and enter deals. So I think it's going to be individual companies, leaderships that are going to decide how they want to take this forward. But I would say still, after all of that, a very important role would be played by the state leadership in just going ahead and making homes affordable in the city. And I would say that this might be the absolutely right time for all complexity of rules and regulations that we are, seeing come up in real estate time to time, continuously shifting the land, the finish line would change. I think a certain amount of rationalization of the approval processes, I think a reduction in time of the various approvals that take place. These are all asks that the industry has been having, would allow good developers to flourish. And when good developers did flourish, I think what you'd see is a lot more availability of the right kind of stock. Because if you observe, it's not going to be following the herd. It's going to be making a statement and actually taking the right decisions. So I don't know if this question was addressed by anybody, but how many of us actually have a proper study of our consumers, the spaces that they use? And we've been spending a lot of time in the last 38, 39 days, where we are having our architecture, our MEP, our engineering team speak to the people who are occupying the homes and asking them what really works and what doesn't. Because, beyond the rules that come out from, in which buildings are being built, there is a very basic line of form follows function. And if we do not know what the function of each square meter or each square foot of space in our homes perform, we're not going to be able to create what we might just keep on squeezing the size of the homes because they're getting expensive and then call it affordable. But that is not really how it should work. What should happen is there should be a deep in-depth study of the consumer, and you should understand the mind of the consumer. And towards that, of course, a few of our leaders have shown that boundaries, in terms of this being across the country doesn't matter. But I still think real estate is largely a localized business. It is driven by certain people who understand the market, who understand the lifestyle, and can build products accordingly. And I think we can come up with better homes, cheaper homes, more valuable homes, not only by building them of a lesser grade or material, but by changing the financing norms for them. So, maybe if Yeah.
Absolutely. So we know we've got a lot of queries come up for Vinod. People are really keen to understand, the way forward for commercial real estate. It has been a very popular asset class for the last 2 years. We talked about the quantity of, we talked about the sheer, quantum of capital that went into this space. Going forward, people have prepared their fund platforms as well as investors globally had prepared themselves prior to the pandemic to put out more and more capital, either through REIT structures or through direct FDI or other mechanics. Now, there are three questions effectively at you. The first, do you think that with the reduced rates or reduced interest rates, there will be a further compression of cap rates? Because Karan on one side has alluded to the fact that investors may actually be looking for a larger return or yield in these times. But on the other side, with a negative interest environment, you actually see cap rates compressing. The second question is, what is your view in terms of lease rentals? There's been a lot of talk about deferment of lease rentals, about lease structuring, about occupiers renegotiating. Do you think there will be any tepidness in terms of the actual lease values? And therefore, what will be its impact on the capital values? And thirdly, most importantly, from a financing perspective, a lot of money went through LRD systems because not everybody wanted to go through a REIT. With change in rents or with change in capital values, do you think there will be a new financing challenge at hand, or will there be a new financing required, which is not necessarily what LRD has done so far? So three
Okay,
questions for you.
sure. So let me address the first part of the question. Interest for global capital for commercial real estate as an asset class is not going away anywhere. It's going to continue to be very high levels of interest. Obviously, next 3 months to 6 months, everyone's going to tread cautiously. But what's happening in the middle of that is that the correction in the dollar has anyways taken away some part of that risk. Secondly, what's happened is, if you understand the footprint of the commercial real estate, like I explained before, 80% is technology-driven companies. Barring a few markets where the rents are closely pegged, probably close to $1 in a few markets and few micro markets in those markets. Otherwise, the average rents across of India for those technology companies are 70, 80 cents to the dollar. And at 70 cents to the dollar, no country can match up to that kind of real estate. You factor that with a replacement cost of asset, and you'll realize that at those costs, you can't replace these assets. Secondly, what's happening is, because of the organized players that have become dominant players in each of these micro markets, they have become dominant not just because they build volume of commercial real estate, but this is a B2B enterprise primarily. So there is a lot of focus on governance, compliance, ensuring that you have a very strict financial leveraging mechanism where you're conservative with your capital in debt, and you're making sure you build the right product. Please understand, in a B2B environment, it's a double-edged sword. So unlike residential real estate in some parts where a little bit of a discount will attract the guy and say, okay, doesn't matter, I'm looking at another window on the opposite side. If I'm getting a discount, let me buy a home. In the commercial real estate piece, it's either right for the consumer or it's just not adaptable to occupy at any rent. So if you're chasing grade A clients, and which is what differentiates you from filling up just a commercial building with different kind of occupiers who may not have a financial standing, that kind of differentiates you dramatically. So if your portfolio is in the right micro markets, if your average rent of your portfolio is really low compared to what the market dynamics are today, if the profile of your customers is absolutely in the space where they have actually, in this environment, proven performance by making sure that the revenues came in, like 95% of my commercial real estate rents have all come in for April. All these clients are top companies globally. They understand business is running, revenues are running, there's no discussion also. So having said that, if all of these parameters are right, attractive capital, good quality capital understands that, and they want to come and invest actually more aggressively in those enterprises that stand out. So in a different way, you will see interest rise for quality assets and quality governance and compliance mechanisms. And the interest rate regime going down certainly helps you in two ways. One is your cost of capital comes down, so you some part of that impact is taken away by the interest costs coming down. And secondly, if quality grade A assets are not available, the yield curve will come down for those kind of assets where the risks are lesser. Now coming back to the other part of your question, where you said that LRDs, etc., may start looking at things differently. This quarter will tell you really that commercial real estate across the globe has earned all their rentals, and the clients have continued to stay occupied and come back and occupy. Like yesterday, governments have released circulars, 35% of people can now get back to workforce. So all of these things really, really help them. And while they were working from home, the revenues have not stopped and their businesses have not stopped. They're continuing to deliver services. So India actually, in a unique way, has performed and has been resilient for giving the services when countries needed it the most, where they were struggling with human resource not being available. India has supported all the services. So that's actually coming out really strongly. Obviously, US balance sheets will slow down on capex expenditures to watch and wait and see if the doomsday is panning out to be less of a doomsday and things come back to normal in 6, 9, 12 months. So you have to just weather this storm for the next 3 to 6 months, and you will see the demand come back dramatically. And we don't see that as a blip at all for the industry. So even for LRDs, banks who have worked on that instrument will now probably put one more lens to look at it more closely to see, okay, what's the quality of tenant, what's the type of occupancy, etc., etc. But LRDs are not going away anywhere. You might probably see a little bit of a margin change in terms of saying that, okay, let's relook at securitizing it better. But I don't think LRDs are going away for commercial real estate at least. You're on mute.
Just as a follow-on question, people have been asking, and clearly social distancing has been one of the biggest buzzwords throughout this lockdown. I'm sure you've already been asked that before. Do you think design changes or portfolio development strategies will change, or cost structures will change for you as you look at going forward with your portfolio?
So like I mentioned earlier, for us, because it's B2B, we are working very, very closely with clients, and in the last 30, 60 days as well, there have been constant interactions with customers on what they want as COVID protocols, what they want as occupational protocols, common area protocols, and we have actually implemented them 30, 60 days, constantly every week upgrading the protocol. So in that sense, we're completely consumer ready to receive larger volumes of people coming back and feeling safe at a workplace. Going forward, what had happened earlier is when they started off in this industry, the average norm was 120 square feet a person. Then it moved to 100 square feet a person. Then at 7, 8 years, 5 years ago, it moved to 80 square feet a person and 70 square feet a person, right? So that certainly they will relook back to see, can we move back to 100 or 120 square feet a person? The second thing that might change in the short term is the fact that you had a lot of variable seating where companies were planning on you can come and sit anywhere, and it was app-based seating, etc. They might have to relook at that and say, I would like my desk to be used by me because I know that I'm not infected and I'll clean my space and I don't know who else was sitting there earlier. So with those things, you might have to change the way you worked for a bit in terms of making sure there's assigned seating, etc. What that means is then you'll have to create more seating for people. And over a period of time, you will see some changes come in the social spaces, etc. But the minute you have a cure announced and a tangible visibility of a vaccine, we as human beings have short-term memories. In 12 to 18 months, you would have forgotten what's COVID and it'll be the new normal back again. But some things will change for the better, where you'll create greater spacing, a far more sensitivity towards social areas and networking areas. So that will stay back, and that's only a good thing because more space will get consumed.
Fantastic. Thank you so much. I think I think we're all very excited about the fact that you do believe that commercial real estate will continue to trailblaze as an investment asset class, and clearly I think you mentioned about cap rate compression. I think that's relevant given that if more capital needs to come in, it has to be not only cost effective but also provide reasonable returns to investors. I'll move to Venki and Venkatesh. I think one of the key things that came out of the polls that we were conducting online, we have almost about 7,000-8,000 viewers, is that there is an opportunity to actually look at design, wellness, and more specifically on the wellness and health side, rather than price being a determinant. And almost 78%, I think participants mentioned that they would rather focus on wellness and health than price. You've always been a leader in that space. Do you think that there needs to be, further accentuation of that strategy when it comes to affordable housing? Because clearly that may continue to be the opportunity set going forward, like you mentioned. Second was also about, in terms of your portfolio mix, do you see, more engagement with tier 2, tier 3 locations as well? People may not want to move across cities too much. They may not want to go out and take jobs in multiple locations too much. Do you think mobility or transferability may be limited, and hence there may be a need to engage with other locations and other cities outside of your current geographic interest?
Yeah, I think it's quite natural that facets such as wellness and health will gain prominence and continue to gain prominence moving ahead with COVID-19. I think the concept of gated communities is only going to increase. It is important that not only the house planning is tweaked to ensure that you have the right enclaves within the house for doing various activities. Even outside, when you're looking at your social amenities, when you're looking at people congregating on the weekends, I think designers like us developers like us will have to pay more attention to the master plan. We'll have to pay more attention to the amenities, and we'll have to pay more attention to an integrated offering in the new normal. So that's clearly going to happen. The second question is, regarding, sorry, what was your second question, Amit? Basically?
No, regarding the geographic engagement, there was a talk about how, metros obviously constitute the larger value mass, but do you think that there will be lesser transferability?
Yeah, so I think this is the entire debate of urbanization, which did gain some momentum in the last 2 decades. And the question is that will people be more safer or feel more safer in their own towns, or will they continue to come to larger metros like Mumbai, Pune and Delhi, which incidentally have been the hotspots for COVID-19? So I think urbanization will continue, I think, but the pace thereof, we need to see how it is going to move ahead. But clearly the demand in tier 2 and tier 3 towns for housing, especially affordable and middle income housing, is going to increase. Whether they come to work to Mumbai or Delhi or not, they would want to own a house in their city of origin. I think that kind of feeling is going to get more accentuated going ahead. So we have to, right now we are focused on the top 6 cities. We have large projects. We're going to be focusing on the entire wellness, the social amenities, the social interaction as a part of our master planning exercise. And going ahead, I think there will be a time where corporate developers like us, like Godrej, etc., will move into tier 2 and tier 3 cities to catch on the wave of the affordable and middle income housing. On mute, Amit.
Yeah, absolutely, Venki. Thank you. I think that's really, I think you all are clearly setting out the tone what viewers and audiences are asking, because they do believe that tier 2, tier 3 may become the need going forward. They're looking forward to large corporate developers like yourselves who are able to provide those amenities, that infrastructure within their hometowns where jobs are likely to get more created. As work from home and digital economy becomes more vibrant, the need to travel to metros becomes less relevant. I will finally move on to Sunil. Sunil, one of the larger, the theme of the entire presentation, of course, was the opportunity set for real estate as an asset class, and clearly how fund managers, investors, and fund strategies will evolve. We've heard about how governance, how collaboration, how the need to create and exercise strategies almost at lightning speeds are going to become more and more relevant. Karan very quickly brought out 3 points for us. The first, that excesses in any form is going to be a no-no, whether it's in terms of cost of capital, whether it's manpower, operating leverage, or any other sort of excesses. Partnerships and consolidation will be the way to go. I think Venki alluded to the fact that consolidation and partnerships also will be the way to go. I think that's a very, very clear theme, irrespective of the industry. Innovation obviously is, innovation which is coupled with technology is going to be a third driver. What I've also understood largely so far, and Sunil, I'd like your perspective also, in terms of what you would advise, investors, advise developers, and advise the larger stakeholder at large, is that there seems to be a need for movement of capital to more equity-linked structures. I think real estate is a long asset class. It needs long money. It may not be liquid, but has the propensity to provide safety of capital, which clearly, in my mind, is a crying out need. Yes, Karan did allude to the fact that there need not be distinction between the various investment asset classes. But I really think that there needs to be that sort of instep between the tenors of and the security being provided by real estate. With the type of capital being provided, we've so far seen 3 types of capital, which I call DOS: directional, which is more asset class based, residential, commercial, retail; opportunistic, which has been a dominant play as well. And now more strategic. I think that is maybe also the need for the hour. Where do you think we're heading, and what do you think you would advise, the next wave of fund managers, investors, as well as developers, for the next year and the years to come, which is in the AC period? You're on mute, Sunil.
Yeah. So the question which Pradeep ji has asked about the affordable housing. So I think it was very important, as even Vinod said, that affordable housing and the commercial real estate, specifically the IT spaces, correct? This is a very specialized real estate and not a commonsensical real estate anymore, because it has a lot of linkages to the risk. It is a lot of linkages to the cash flows. It is a lot of linkages to the profitability. And that actually makes the asset class very attractive. So my view at this point of time is my suggestion or advice to offer to the fellow stakeholder developers who are there on the panel or otherwise is only do what are you good at. Don't try to follow the herd. I think it is more important that you are good at something. You have built the brand for decades. Because just there is a herd and there is a mentality that to follow the crowd is not going to work. So the counter-cyclical opportunity is bound to be there. Know your strength. Focus on that part, and it's very, very important. Now, coming back to the second point, once you develop that kind of confidence in the mind of an investor or the end customer, I think today every end customer or investors, institutional investors like us, are probably looking at first is the safety. And the safety has an underlying quality, whether there is a quality, whether there is a predictability, and there is a certainty. So that safety is one important factor which aligns the interest of the developer, partner, and the investor. The second is the liquidity, which also aligns the interest between the developer, partner, and the institutional investor, because if there is a liquidity, then only both the parties probably get benefited. And the last is returns. So my sense is that today, going forward, the first two are going to be very, very critical, where you will find safety followed by quality and followed by predictability and certainty, which will create liquidity. The returns may not be the only criteria to make or break the deal. So my sense is that whether it's a debt capital, whether it is a structured debt capital, structured equity capital, or equity capital, definitely will come in. Now, coming back to the last segment, as you rightly mentioned, Amit, last segment of investors who have vanished from the scene for last 5 years because they were intellectual in their mind. They said staying in the rented accommodation is a great idea than buying a home. Whatever money they saved, they have put it into an asset class. And I agree that equity is not the equity or real estate are not either or, they are all coexist together. It's an asset allocation call. But if one has over allocated to the equity as an asset class, thinking that is more liquid and it was generating a lot of returns, I think in the post-COVID period, maybe a 6-month, 9-month period from now, when the normalcy will stabilize, I see all those people who have not owned the home will own the home. The people who have felt the need of a larger home or a better home or a gated home or a more secured home will come back. A lot of people would also find that the rental yields would also increase from 2.5% to 3.5%. And the home loan rates, and to my experience as a banker and leading the housing finance business for the bank for 10, 15 years, the 2006, when we reduced the interest rate to 7%, I saw the magic of growth. And this time, it's very clear that the home loan rates are bound to be between less than 7% in this this calendar year, or maybe the financial year, or maybe in a 12, 15 months time. So lower interest rate regime is going to help. So I see clearly a very positive journey as far as the post-COVID area is concerned. The question, Amit, then what you were asked is, how do you survive? So the first risk what each one of us are carrying is not the COVID risk. The survival risk is the most important. And once you ask that question of survival risk, then you will ask for what kind of capital, what kind of sharing of returns you will do, what kind of controls you will give it to them, if you have to continue the project, and how do you get an exit to the existing NBFCs or the banks. So my sense is that you need a patient capital, and that patient capital is waiting, provided there is alignment of interest. So I clearly see there is going to be a lot of rethinking, and this thinking is very, very important while going forward.
Thank you very, very much, Sunil. I think all of the polls also mentioned that, and to Venki's point, that millennials may likely to now become the new consumer class from moving from co-living. It is quite likely, and majority of them felt that there may be again a shift towards young buyers. Where the age may again lower down, and there may be again a new entrant of home buyers, which is the millennials. Also, Venkatesh alluded to the fact that there could be more localization of demand, and hence there will be need to create products and services at the local level. Also, we had a similar view from Vinod, who said that service levels are most critical. Without services, there is no product, and therefore service levels will continue to be accentuated, irrespective whether it is physical or digital services. Most people have also maintained the fact that I think there are 3-4 common themes that have come out throughout this event, and I think it's fairly clear that there will be need to align to longer-term goals and objectives. Either whether it's short-term capital or short development cycles or short promises will not work for anybody anymore. There is a need for more strategic direction. There's a need for more longer-term outlooks, and therefore only accepting partners and opportunities that have similar alignment and not otherwise. And that will obviously lead to more consolidation. Boman pointed out the challenges that people may face, including whether it's Venki here at Shapoorji or Godrej or others who are leading the entire spate and who will lead the entire spate of consolidation in favor of consumers and for the industry, that there are certain transaction cost challenges and there are certain regulatory and legal hurdles which the industry as a whole, as an industry body, will continue to work with the government. The cost of capital, yes, has come down. I think there is a clear direction being given that there will be a negative term structure on the interest rate side. There needs to be a continued drop of repo rate. I think we're at 3.75%. Sunil, you alluded to the fact that any reduction in interest rate environments definitely creates a spurt in demand. I think that is statistically proven as well, whether it was 2004, whether it's 2010, or even before that, or even now, that there will be a spurt in demand. Of course, because of the pandemic, there may be a lag to that effect, but clearly a negative term structure is what everybody expects. Despite that, the cost of capital to real estate still seems to be high. It is not in line. There is not a transmission of that reduction onto the sector, and that is largely because of the issues of transparency or governance or risk factors which are unknown to most people and they don't know how to manage it. I think this entire speed, innovation, governance, transparency in the hands of some of the leaders who are here with us will clearly lead to that effect where On one side, there is we have a better dollar rate regime. We have unshackling of FDI policies, but there is a lot which needs to be done by the government. But demand is intrinsic, it is static, and it will be there. So there is no doubt about that. So Sunil, you've clearly mentioned about governance and about focusing on core strengths. Again, a very, very strong underlying theme. Everybody said, focus on your core strengths, no need for unnecessary diversification, monetize non-core, get back to core and basics, partner on non-core strengths and strategies. I think, again, a very, very strong underlying theme. It is survival with the core and going back to basics. That is going to be the large theme, that survive, cut the flap, go back to core and create partnerships. Consolidation and therefore supply chain consolidation or partnerships will be the name of the game. Innovation clearly is being demonstrated by several of us here, whether it's through technology, whether it is through communication, whether it is the way we've handled. And Venki very rightly mentioned about something which is very unique, which is the supply side disruption. Demand side disruptions have been many. Supply side disruption remains one of the key challenges and one of the leadership challenges I see going forward, because we will need to ensure that people who work for us, work with us, work within the projects and the supply of men, material, equipment are in a manner, are in a phase, are in a strategy and in a direction that creates and espouses confidence amongst those stakeholders to continue to be aligned and grow this industry forward. So clearly, I think that is something which is really unprecedented. We've dealt with demand side, supply side was very rightly brought out by him. Venki, so thank you for that. You also talked about three very, very crisp points. The fact that apart from consolidation and partnerships, I think creating long-term funding and right kind of funding partnership is very, very critical. A lot of the pain or the pain has come because of misalignment within the funding structures. We did hear the fund managers and investors talk about how there will be evolution with times to more long-term investment strategies, more patient capital and more equity-linked structures. So I think clearly that seems to be happening in that direction. And finally, Vinod mentioned that there is a continued demand. There may be a slowdown in terms of absorption, but surprisingly, what we learned that we are not seeing any lack of payment on rents. He's corrected 95% of his rents. That's phenomenal. And Venki, I hope that's also the story at the sales end for you. All of us are able to collect more money than the automobile sector or the governments. I think that's critical. We have a large supply chain to feed. We have obligations to the GDP and the industries that we cater to. And clearly people look up to you to be able to do that. So, more power to all of us. I again thank everybody for being around. Sapna, over to you. It has been an exhilarating 1.5 to 2 hours. We've had extraordinary participation, extraordinary number of questions. Even the entire day would have not been enough to have such a spectacular audience and such spectacular speakers with us. Over to you, Sapna.
That was quite a summarization, Amit, you gave. But we have the poll results as well. And, there are some very surprising results that we have got, which kind of differ from what the speakers expressed. So, when we asked, buying would be as an investment over leasing, over renting, we were going to prefer. It was a mixed reaction. While 35% said yes, 33% said no. So it is a very mixed reaction. Again, another mixed reaction is on would they prefer real estate over financial markets? It's 39% yes and 33% they say no. So again, a very mixed reaction. But there is a clear favor for branded developers, even if there is a brand premium. There is a clear preference for projects that have good quality and wellness. It is 76% for such projects, 73% for branded developers, and ready to move in projects are clearly favored by our viewers over under construction, even if they have to pay higher interest rates. Millennials, surprisingly, the results we have is again 50-50. 44% would like to go for buying rather than renting. But there is a clear indication that yes, India is going to be a preferred destination for investment for NRIs. 79% saying that. So that's a good news, I think, for real estate, that we will be getting a lot of funding. So, but yeah, it was a very exhilarating, as you rightly said, was a discussion, and everyone, their viewpoints. I think we got a whole mix of viewpoints from all sectors. So thank you all. Thank you, Mr. Gopalkrishnan, for taking out your time, being here with us. Sunil, thank you for your expert views. We have a lot of questions for you, which I'm going to share offline with you. So thank you so much. Amit, I have questions for you as well, which I'll share with you offline. So
Thank you.
limitation of time, we could not take
Of course,
as
of
many
course.
questions, but we'll have a report coming out after this, based on this session, and we'll try and address as many queries as possible. Thank you everyone for being here.
Thank you. Have a great weekend. Stay safe, stay well.